Welcome to the Loans Incorporated podcast. I'm Alex Pagano, Vice President, Loan Originator of Loans Incorporated. I've helped hundreds of families refinance their home. I'm here with Dhan Thomas.
My name is Dhan Thomas, the branch manager of Loans Incorporated. I've been doing this for 3 years. I've also helped about 100 families get their first home or their investment properties.
Good. Well, I'm really excited for this podcast today because we're going to go over a lot of topics and overview and help people who are lost in the sauce when it comes to mortgages because there's so many different topics and loan programs and things out there. And I feel like this podcast is perfect for the people who aren't sure which program, what's out there for them.
Ask away. I'm ready.
Cool. So a little bit about what we're going to go over today. We're going to go over conventional loans, FHA loans, USDA loans, VA loans, non-QM loans. If you aren't familiar with these are the programs where you have to show less documents compared to a conventional loan or FHA loan. Think your bank statements or a profit and loss statement. And we're also going to go over investor programs like the DSCR loan, fix and flip, grant programs, and reverse mortgages and HELOCs. So Dhan, tell us a little bit about the steps once you are in the process and wanting to buy a home. Tell us a little bit about the steps about getting a mortgage and what it's like once you actually start the home buying process.
All right. I'm glad you asked. This is a great question because a lot of people always wonder where do they start. So the first step is talking to a loan officer and a realtor. And let's say you don't have any realtors you can contact, reach out to a loan officer. I'm pretty sure they know a bunch of realtors in your neighborhood or your
we
vicinity.
can help get you hooked up with a realtor and who we've worked with through and through, who we trust and that can help you in the whole entire real estate process.
And that's key that you said trust. You kind of want to work with people that you have the faith and trust to get the job done. So if you're reaching out to either Alex for a loan or for me for a mortgage help and you don't have a realtor, don't worry. We'll guide you in that way. But anyway, first step is talking to a licensed loan officer. And by talking to a loan officer, you'll figure out how much is your pre-qual amount is, how much you can buy, how much, what neighborhoods to stay, what neighborhoods not to get in, based on your purchase price, school district, all that stuff. So loan officer will help you guide you through that process. Once you get a pre-qual amount, once you get the pre-qual letter and a realtor to work with, then it's their job to start getting you appointments.
Now, Dhan, can you answer this for the audience? What is the difference between a pre-qualification versus a pre-approval?
Pre-qual is when you send the loan officer your W-2, pay stubs, driver's license, and they'll do a soft pull, just get the basics down to figure out how much what purchase price you should be at. A pre-approval is you don't have a subject property in mind, but you want to see if an underwriter will give you a clearance on your loan. So basically, a pre-approval is without a purchase agreement, without being under contract, an underwriter will look at your file and application and will give you a stamp of approval and get you pre-approved. And the difference is a pre-qual, Alex and I can do it. A pre-approval, an underwriter would have to do it. And obviously a pre-approval letter has more value than a pre-qual letter.
Correct. And I agree. And I think that's kind of what sets our company at Loans Incorporated apart a little bit because we go the extra step to have the underwriter take a look at it. Because most companies, when they give out a pre-approval, this is based just off of the loan officer's eyes. And while I believe you and I are very good at our jobs, we're not perfect and we're not professional underwriters. So
agree. And that's not our job.
And we can also leverage these pre-approvals from the underwriter when we actually get your loan under agreement, under contract, because we can say, hey, our income was approved for this amount by this underwriter, and it puts you one step ahead and one step closer to getting to your clear to close.
Yep. And in a bidding war like we're in right now, a pre-approval letter has more value than a pre-qual letter. And like what you just said earlier, it will get you ahead. Like a house may have 10 offers coming in. It might be a soft pull, hard pull. It might be different versions of a pre-qualification letter. But at Loans Incorporated, with the pre-approval letter, it will win your bid over someone else.
Yeah, awesome. So we have a lot of topics to go over, as we discussed. So I want to go right into a conventional loan. Conventional loans, I feel like they're kind of the gold standard of mortgages. So we'll go into the pros and cons of conventional loans. We're going to go into some of the common myths, and some of the affordable loan products with conventional loans. So first and foremost, Don, what is a conventional loan? Because I have the definition right in front of me, but just based off of your understanding as a loan officer, how would you define a conventional loan?
How I would define a conventional loan is if you have more than 620 credit score, you can put as low as 3% down for a down payment, or go as high as 20 or more if you wanted to.
And we're going to talk about that as well.
Yep. And then, so the conventional, you can go as low as 3, high as whatever you want. And the credit score minimum is 620. A conventional underwriting has different guidelines compared to FHA. FHA, you have as low as 3.5 down payment. And the minimum credit score requirement is 580 to put 3%. Let's say you have less than 580. You can go as low as 500 credit score and put 10% down.
And we'll talk about that once we get into the FHA section. So like more or less for conventional, and I think just people kind of misconstrue what a conventional mortgage is. And I think it's just as simple as it's a loan that's not backed by the government. These FHA is backed by the government. USDA is backed by the government. VA loans are backed by the government. So these loans are from private lending institutions. So these are your lenders. And then they follow guidelines set by Fannie Mae and Freddie Mac, which are both two government-sponsored entities. So if you heard of Fannie Mae, Freddie Mac, they're quasi-government agencies, and they kind of set the standard for the guidelines that these private lenders follow. But God forbid someone were to default on their loan, these private lenders would be on the hook. Whereas if you had an FHA loan, USDA loan, VA loan, the government insures these loans and the potential default of the borrower.
So I'm glad you said that, because that ties into the pros and cons of an FHA loan.
Yes.
FHA being federally backed, you have that upfront mortgage insurance. 1.7% of the purchase price is you would have to pay an insurance fee. You can finance it into your mortgage, so you don't have to come out of pocket, or pay out of pocket. So let's assume you want to buy a $500,000 house. The FHA, you have a 1.7% cost for automatically right off the top. Conventional, you don't.
Exactly.
And then another con with FHA is that mortgage insurance is lifelong.
Right. No, we're going to talk about this all in the FHA section, man. Let's keep the audience, waiting for that section.
So conventional, I would always recommend conventional, but the drawbacks with conventional is you can't go more than a duplex on purchasing. If it was a duplex, 5% down. There are some products out there, and it's not all the time, that you can buy a triplex under conventional methods. However, it's income based, area based, so it gets a little tricky and windy. It's very demographic based, but FHA right off the bat, you can go 4 units. 3 units, no questions asked, as low as 3.5% down. I'm a person who have used the FHA product. It has one deals over and acquiring properties versus a conventional. Both are great loan products. Both are great for first-time home buyers.
Well, let's go into some of the pros and cons.
Okay.
So some of the pros, and you went over some of these points, where there's no private mortgage insurance after 20% down. So once you put at least 20% down, you do not have any private mortgage insurance. And that's private mortgage insurance is for protecting the lender in case you were to default on the loan. You stop making payments, you have foreclosure. Private mortgage insurance companies insure the lenders. So I'm going to ask you a question. You can buy this mortgage insurance out at closing, right?
Correct. Out-of-pocket expense, you can pay at closing or finance it, group into your loan.
And who can also pay for this?
The sellers, as a seller credit.
And the lender.
Oh, and the lender.
And the lender too.
With the lender credit, essentially.
So fun fact, if you're putting, let's just say like 15, 16, 17% down, just under 20%, you just pay it off at closing. So you don't have to worry about it each month.
Alex, only drawback with that is I have customers who have closed previously without any lender credit. Can you believe that?
It's crazy.
So a lot of people don't know this, that as a person buying a home, your lender could also give you some credit. It's called lender credit. And there's not just sellers. It's just not, grants or whatever, but your lender gets lender credit. I have clients who I've closed on, and there's like third time buying a home, or this is a beach house, summer rental, whatever it may be. And they were surprised, hey, what's this $5,000 lender credit you gave? And I was like, who gave that? And I was like, the lender credit. It's like, I'd never seen this before. And yeah, and that will help finance your private and mortgage insurance.
Yeah. So it's always creative. There's always creative solutions, if especially have a goal in mind. And also private mortgage insurance is typically lower than FHA mortgage insurance premium. So mortgage insurance premium is fixed, and we'll talk about that in the FHA section. But for conventional loans, it's typically lower, especially if you have really good credit. It's usually lower. So going on to the next pro is typically there's less documentation required by the underwriter in a conventional loan compared to FHA. And this is true specifically for those self-employed borrowers because, as you know, with a conventional loan, if you've been in business for 5 years or more, you only need one tax return for underwriting. But for FHA, if you're self-employed, you need 2 years no matter what. So this is, I think, a great option, especially if you're self-employed, where you only need 1 year to qualify for. Moving on to some of the cons, right? So like you mentioned a little before, is you need a higher credit score compared to FHA. And you said the minimum is 620. But there's a caveat about the minimum credit score. Why don't you tell us a little bit about that?
So yeah, the caveat with 620 credit score, just because you have a let's say 622 credit score, you have good income, but your debt to income ratio, that means whatever your gross monthly pay is, divided by take 50% of it, and then you subtract away your monthly liabilities, and let's say your ratios are at 49%. Even though the eligibility for a conventional loan is 620 credit score, 49% DTI, if your ratios are too high, and every bank does this, every lender does this, they run your application on an AUS system.
It's just a computer. Just a computer saying yes, no, or maybe. You really need the yes every time. Oh, you need the yes.
Yep. And it's really a thumbs up, a green light, depending on the system. So it's simple as that. You run your numbers, you run your income, everything goes under I don't know if it's AI generated, but it's definitely an automated system that looks at your income, looks at your credit score, looks at your credit report, any delinquency, derogatory, any charge-offs. So it will spit out of ratios, and just because you have all the minimum eligibility for conventional, if the system gives you a middle or down thumbs down, you can't go conventional. It will recommend you going FHA.
Yes. So, and you can typically, if you do have a lower end of the credit score, but anywhere under 660, so like 620, 660, if you put a little more down, and if you have a low debt to income ratio, your chances of getting the green light for conventional loan are much higher. But you're pretty much golden, even if you're putting a lower down payment, maybe your debt to income ratio is a little higher to that 50% or a little closer. I think if you have over 660, you should probably get the green light.
Yep.
Good. All right. So,
and 660, 680 is the credit score you want to be to get grants.
Yes.
And usually grants are tied with conventional because, again, if you have a 680 credit score, you're not going FHA unless you're buying a multifamily, but the grants won't cover anything more than a duplex anyway. But
right. So another con is you're required to put more down if you're not a first-time home buyer compared to FHA.
Correct.
So you can explain this a little as well, but if you're not a first-time home buyer, you have to put at least 5% down. But if you're a first-time home buyer, you can put 3% down, which is actually technically lower than the FHA minimum.
Oh, 100%. To be honest, a FHA 3.5, you don't forget, you still got to add that 1.7.
Yeah, that upfront mortgage insurance.
So you're really putting a 5.5, 5 points.
The difference is you can finance that.
You can finance it, but it's still part of the loan.
Correct.
But yeah, it's still higher. 3.5 is still higher than 3.
Right.
And if you don't finance it, and it's out-of-pocket expense, then you're looking at a 5% versus 3. And then lifelong mortgage insurance with FHA versus conventional will drop at 20% down or 80% or 20% loan to value.
Correct. So last segment for conventional loans. Well, not the last segment. We're also going to go affordable loan products, but let's go over some of the common myths. Common myth one is you need 20% down to buy a home.
You know how many? So I feel like don't want to say this on air, but I feel like there's a lot of realtors out there that has the old information. that tells people, oh, you need 20% down to buy because you're going conventional. That's false. You can, again, like what you said earlier, you can go as low as 3% down if it's your first home. And do you know what first-time home buyer is defined as?
No, explain.
First-time home buyer by the banking world or the mortgage world defines as if you bought or sold more than 3 years. So that means if I bought a house, let's say 6-7 years ago, and I sold it 3 years ago, I'm qualified for another.
Right. Your first time home buyer again.
Yeah.
That 3 year time period is passed.
So every 3 years, I could be a new first-time home buyer.
That's awesome.
Or you can get another conventional loan. Again, this is up to manual underwriting discretion. But let's say your job change. Now you have 2 kids versus maybe no kids before. Now you need to move to the neighborhood where you need better schools. Maybe just 30 miles away from your current home. You could, again, qualify for a first-time home buyer, 3% down. So it's a myth, common myth. Everyone thinks because back in the day, your parents, your uncle, someone you know in your family bought a house putting 20% down. Yes, putting 20% down sounds crazy, but back then when houses were like $200,000, it's much easier to do.
And there's a lot of misinformation out there. So that's why come to Loans Incorporated YouTube page. We'll tell you everything.
Yeah, we'll give you the most updated information on Loans Incorporated page.
Yep. Let's fly through these next parts because we have a lot of topics covered today. You need perfect credit. As we went over, minimum credit score is a 620. If you have some lates, some things that are on your credit, as long as your FICO is above a certain threshold, like we say, you don't need perfect credit. Conventional loans are only for primary residences. That is a complete myth.
You could, again, do a second home, 10% down with conventional. You can do investment, 20%.
Yep.
But yeah, this is why, to go back to our topic earlier, before you start looking at homes, if you have the concept of buying a home one day, talking to a mortgage officer is very important, because especially at Loans Incorporated, we will go over not only the steps and the process, but we'll give you different scenarios on how to structure your loan for the purchase you want or need. And every client, every case, every scenario is different. It's always case by case. So you really want to talk to an experienced licensed loan officer to guide you in the right way, to get you the right loan product. There is no one loan that fits all. There is conventional loan products, but that has affordable, like home possible, home ready loan products within the conventional categories. And sometimes FHA is better if you're a recent graduate. A lot of people who come out of school think, oh, I can't get a loan because I don't have a 2-year work history. Another common myth is you need 2-year work history. Me and you both have done loans for traveling nurses. We both have done for recent graduates. I have family members who graduated like 6 months ago that are homeowners. Why? Because FHA allows you to be a recent college graduate or any kind of graduate.
Conventional as well.
Just a working professional. If you can prove that you were in school for the last year, 2 years, and you just graduated and you're now working a full-time job, that's all you need. You don't need work history. You just need to show professional history. So going to school, again, that's when an FHA loan product is better. You could be a perfect candidate with 800 credit score, having 20% down, but conventional, you at least need that work history.
Yep.
With FHA, the workaround is being in school.
Yep. So another common myth is conventional loans are harder to qualify for, which I don't think they're any harder or easier. I think that FHA, calling for FHA or conventional, are probably pretty similar in terms of getting approved. I actually think conventional loans can sometimes be easier to qualify for, and not because of the debt to income ratio or some of the other requirements compared to it. If you have a good credit score, good debt to income ratio, not even a high down payment, I think that they're easier to get approved for.
So in my experience, I've seen it being easier if they have some kind of assets. Let's say you have like $20,000 in your 401k or your $30,000 in your brokerage account. So having some kind of assets in your, because a bank wants to see that you have reserve savings. You don't need to touch this money. You can just show that, hey, in my 401k, I have $20,000 sitting there growing. Great. We could put that in your assets, put that in your underwriting system. And again, you could be a 620 credit score person, just about 2 years of work history. But if you didn't have that asset, you'll get refer on your underwriting, manual automated underwriting. But if you now have substantial amount of assets to show as reserves, you might get the green light.
Good.
Again, these are not things that you as a client can do on your own. People always, I've been checking my credit score on Credit Karma. I know what I'm at credit score wise, or I know what I have in my assets. But no, a hard pull from your lender, running it through the automated system, putting all your numbers in, what you have in your assets, your income, your debt, that automated underwriting system, which only a lender can get to you, is really the first line of defense or first line of offense on buying a home. We can do all the math at home, but that math ain't mathing right until you talk to a lender and until you, because at the end of the day, the money's coming from the bank. The bank's automated underwriting system, manual and automated, needs to give the thumbs up, needs to give that green light. And again, there will be no charge to you as a client or as a borrower for any of these services.
Correct.
At Loans Incorporated, you come to Loans Incorporated, you want to get a pre-approval, pre-qual, you want a loan officer to look at everything start to finish, so you know a lender's not dropping the ball after going under contract.
There's no application fees, no junk fees.
Nothing.
No.
It's all at our cost.
Last common myth, we'll touch it real quick just because we have so many topics to go over, is PMI lasts for the life of the loan. That's not true at all.
Not unconventional.
Not conventional.
Nope.
No.
Nope.
That falls off once you reach 78% loan to value automatically. When you hit 80%, you can request it from the servicer for it to be removed.
So basically, let's say you buy a house at $500,000, putting 10% down. So your loan is $450 loan size. Once your house value gets to $550 or $550, and your loan amount gets at least a little bit lower than that, if you divide your loan balance over what your appraised value would be or its estimate on the house, if it's at 80%, you can call your loan bank and be like, hey, I think it's at 80% value. Yeah. If it's at 78, it should automatically fall out.
Yes.
Again, these are stuff that you should be talking to a loan officer to help you guide you in the right way.
We'll guide you all the way through it. We're your loan officers. So.
Oh, can I interject real quick? Talk about something, that a strategy that a client and I came about today. So a client called saying, hey, I don't know if I should put 3% down or 20% down on a home. I was like, all right, let's figure out, what would you do by not putting that extra 10% or let's say it's extra 15% down for the loan? He's like, oh, I just want to leave it in the bank. I was like, he's like, he was saving up that 20% to avoid the PMI. He has great credit. His PMI when I ran on the system was $80 a month. At most, $900 a year, $920 or something, $960 for the year. So I was like, hey, you can spend $960 a year on mortgage insurance. Just put 5% down, and that extra 15% put in a high yield savings account. Put it into ETFs. Right now, high yield savings are giving you 5% return. Any ETFs are giving you on average 7 to 12, 13%. So he's a client that has great income, great savings. He didn't know what to do. He talked to me and we came up with an idea. It's like, let's reinvest the money and put it into anywhere else. You know, you're only coughing up $920, $980 for mortgage insurance. So, and that's also a tax write-off, a tax deduction. You have tax deduction for about $1,000, a little less than $1,000. You reinvest your money into something. And people always think that the mortgage insurance is for the life of the loan. No. Forced depreciation. Within a year, with some kind of minor renovation that we all will do once we move in, your property value will appreciate. You call the bank and say, hey, my property appreciated. So without putting 20% down, you let time do its thing. It's called forced depreciation. And the bank has to drop off that mortgage insurance.
Awesome. Oh, that was great. Well, let's go into some of the affordable loan products with a conventional loan. So the first affordable loan product we want to talk about is Home Possible and Home Ready. So the key with Home Possible and Home Ready is you have to be at 80% AMI, area median income, or lower. So the way you can tell whether or not you're at 80% or not is a tool called the Fannie Mae AMI lookup tool. You can find this right on Google. Also, Freddie Mac has a tool through the same search criteria, and this is just through Freddie Mac Home Possible. You go ahead and you Google the address of the property of where you're buying, and it tells you what percentage you have to be at or what salary you have to be at 80% AMI. Now, if you're over the 80% AMI, unfortunately, you don't qualify for this program. And we'll go over the benefits in a minute, but you have had clients, especially in high cost counties. So what are the differences between if you're in a regular average cost county compared to a high cost county? What happens with home ready or home possible?
So what you asked was the home possible, home ready. So I'm using 19115 as an example because I do a lot of loans out of that zip code. The AMI for that neighborhood is 114,000.
That's 100% AMI.
Correct. And then the 80% of that is about $92,000.
Right.
So the 80% is the $92,000 is the threshold you need to be or below.
Now, what about if we go up to like Bergen County or some of these areas in North Jersey? That goes up to another threshold.
Yep. I believe 16. Don't quote on. Go
About 120, right? Somewhere.
Yeah, 120 on the 80%. Then I'm always looking at the 100% value. But it is definitely
go
higher.
Up to 100% though.
Yep.
In those counties.
Yep.
So if you're in a high cost county, you go up to 100%, and I think regular is 80%.
80%. Yep.
Yeah. Okay.
And this changes, and the income limit is also changing every year. So that's why you would want to go on their website, type in the zip code, or if you know the address, type in the address. Find out what that year's income limits are for that specific county. It varies from North Philly to Bergen County. It varies from South Philly to like LA. It doesn't matter where you are in the country. Look up on that tool, or again, talk to your loan officer and ask them, hey, what income limitations do I have to get qualified for these affordable conventional loan product? And here's another strategy that Alex does, and I really appreciate it for Alex for doing this with his clients is if you have two people on the application applying for a loan to buy a house and they want to qualify for this affordable loan product, if one person can carry the entire note of the mortgage, there's no point of putting two people on the loan. You can put two people on the title, so both parties have rights on the property, but one person's carrying the note, they'll qualify for the lower rate. This is great for married couples because, the chances of them staying together, keeping the house, mortgage paid and all that is much statistically higher. But yeah, so it's a great opportunity. If you talk to your loan officer, strategize that way as well, is to, if one person can carry the note, the mortgage, the chances of them qualifying by themselves for that affordable loan product is much higher than having two people.
Yes. And let's go over some of the benefits of home ready, home possible. So biggest benefit is lower interest rates. So
almost 0.5 difference.
Yeah, almost a half a point difference in the interest rate if you can qualify for home ready or home possible.
That's about $200 a month savings on a $500,000 house.
And you can still go as low as 3% down on a conventional mortgage.
And I think the mortgage insurance is cheaper.
The PMI is lower
by a couple bucks.
It is, yes. It is lower on home ready, home possible.
So overall, it's a great product, but not everyone qualifies.
Correct.
Especially if you're married, applying jointly to buy a house together, chances are you're not going to qualify because your income is just going to be too high.
Yeah.
But again, a great loan officer or an experienced loan officer knows that, hey, you don't have to have both people on the mortgage to qualify them, and to get them the best rate, have one on the loan, both on title, everyone's happy.
Correct. Next program that is an affordable conventional loan product is the 1+. So the 1+ loan product is a 2% grant from the lender. So if you're putting a minimum 3% down, it's almost as if you're putting 1% down because that extra 2% is being covered from the lender. So there are some stipulations with this program. So there is a grant floor. And this is $2,000 for clients between 50% AMI to 80% AMI. So if you're within that threshold, you can get 2% covered up to $2,000.
Yep.
And then there's a grant floor for clients below 50% AMI. That's going to be $2,500.
Yep.
So 1+ is a great program. I've closed some customers with the 1+ product. It definitely is good. If you're trying to get into a property, you don't want to go with other down payment assistance programs. You want to stick to a conventional program. You want to still keep as strong as an offer as possible with a conventional loan, because even though I don't 100% agree with it, sellers consider conventional pre-approval stronger than FHA or other government-backed loans.
Yep.
And then just want to touch on the conventional home rate break program. So this is another affordable conventional loan product. Have you heard of this one yet?
No, actually, I have not heard of this one yet.
So this one just came out. So the home rate break is a lender paid 2-1 buy down. And this is applied to all eligible home ready purchase loans. So just like the criteria we talked about for home ready and home possible, you have to meet the area median income limits. There's also a loan amount limit, and that's $350,000. So for this program, so all this is saying, let's just say the interest rate is today 6.5%. So the effective interest rate in year one will be 2% below the interest rate. So if it's 6.5, year one, it'll be 4.5. The effective interest rate in year two will be 1% below the interest rate. So then I'll go up to a 5.5 for year two. After year three, the interest rate will return to the rate at where it started, 6.5. So it will go to the 6.5 when you initially lock the loan. Now, here's the best part about this program. There's no prepayment penalty or restriction on prepayment. So you can refinance this home at any point. So if the rates come down and it's a good time to refi, you're way below that 6.5, then go ahead, pull the trigger and do it. So I think it's a great product. If you're banking on the rates coming down, you get the lower rate now. So you have a real comfortable payment at 4.5%, whatever the rate is. And then if they come down at any point, just refi.
And correct me if I'm wrong. I heard with this rate break or the 2-1 buy down that sometimes the sellers can pay for this and seller's credit.
So yeah, on a regular buy down, temporary buy down, the seller can pay for this. Actually, any party out besides the borrower can pay for this. So this program specifically is the lender is covering that for the person. But if you wanted to go with, let's just say, the 1+ product or a regular home ready product, you can actually just do home ready with a low rate, really low market rate, and then have the seller give you a credit to do a temporary buy down. So with the home rate break is just saying the lender is going to buy the temporary buy down instead of the seller or any other not any other interested party besides the borrower, if that makes sense.
You know, it's crazy that we have been able to help families get into homes with the buy down programs. Especially with the grant program, I was able to combine the Philly First with the 1+ as almost with just $1,000 out of pocket. I've done 3 deals where the client came with just little over $1,000 to buy a $300,000 home.
Yeah.
And there's been a handful of deals I've done where borrower did not pay more than $9,000 for $400,000 home. Rest was all covered between lender credit, grant, and the assistance program.
Yeah, that's some awesome stuff.
In today's market, in 2024, especially since 2021, if you actually have the mindset of buying a home, it can be done. More than having the assets or the funds to buy a home, there's tons of great program out there. But it's really, in today's market, you can definitely get a home with honestly less than almost $1,000 out of pocket.
100%, especially if your market is affordable, like Philadelphia.
Correct.
Yeah,
especially if you qualify for if you're looking for homes in the 350 range, you can definitely get a home in today's market.
100%. And then last point on conventional loans are jumbo loans. So jumbo loans, these are any loans that are outside or surpass the conforming loan limits. So 2025, the loan limit has been announced that it will go up to $802,650.
Okay.
Which, when I first started in the business over 5 years ago, it was still in the 500s.
Yep, I remember that.
Yeah. So it's gone up quite a bit since we've been in mortgage specifically.
$300,000 in loan. That means you out of 8, you suppose 850 for next year.
802. 650.
And you could still put 3% down.
You can still put 3% down.
On
Isn't that incredible?
802. Wow, that's wild.
Yeah. Now, I mean, you have to be making the income to float that. So it's still amazing though. So next section, we're going to be going over FHA loans. So we're going to go over the pros, cons, common myths, and also some down payment assistance programs with FHA loans. All right.
Let's get to it.
All right. So an FHA loan is just An FHA loan is a type of loan that is insured by the Federal Housing Administration, the FHA. So that's a government agency that's part of the U.S. Department of Housing and Urban Development. These loans are designed for low to moderate income borrowers and for those who may not qualify for conventional mortgages due to less than perfect credit, lower down payments, or financial limitations. So let's get into some of the pros.
The pros that sticks out to me is the fact that you can go up to 4 units. You can buy a multifamily quadplex with 3.5%.
So explain some house hacking with FHA loans.
Okay. So you're fresh out of college, recent graduate. You've been in the workforce for 6 months, and you're tired of paying rent, or you want to move out of your parents' house, but you want to, not spend too much on your monthly mortgage. An ideal situation is finding a duplex, a triplex, or a quadplex where you can live in one unit, rent out the other units, and cash flow. And that's house hacking, where basically your mortgage is covered by your tenants. And your investment is 3.5% down. Let's say you're in Philly, 6% closing costs. You're looking at an average $300,000 duplex. You need $30,000 out of pocket expense, or total cash close expense, $30,000. Now, you can now combine that with grants, where you might be just paying $10,000 out of pocket. You're buying a multifamily where mortgages, let's say on a $300,000 mortgage in Northeast Philly, is probably $2,500, but you're collecting about $2,000 rent in one unit. You're basically living there for $500 a month, $1,000 a month.
That's awesome.
Isn't that beautiful?
That is beautiful. Now, not everyone wants to be a landlord and have tenants. So there's still some other amazing pros. So that avoid that, right? So one of the biggest pros is you can, with a 3.5% down payment, have as low as a 580 credit score. And you had mentioned this a little earlier in our show, where if you have a 500 credit score, you can still buy the house.
Yeah.
So what's the only caveat with that?
Instead of 3.5% down, you have to put 10% down. So when people always say, "Oh, I have a little bad credit," and I was like, "How much is it?" And they're like, "Oh, 560, 570." I was like, "You can still buy a home."
Yes.
Again, if you have the down payment money and closing costs, you can still get a home. You can still qualify for a mortgage.
And you can also still qualify for a purchase, but you can also still qualify for a cash out refi.
Yep.
So I helped a client who had a credit score that was close to 500 and they wanted to pay off some debts and consolidate debts. They own their house free and clear. So they're like, "Hey, Alex, I want to take 100,000 out of my house and pay off these debts." They had less than perfect debt, or they had less than perfect credit score. We did the cash out refi, debt consolidation, and they were able to qualify with an FHA loan. So it's not just for purchases. If you need to refinance and pay off debt, you can absolutely do that with an FHA loan.
You know what's crazy? That I've done more refis in the 6% market range than in the 3 and the 4s. When it was 3 and 4, I had a lot more purchases than refis. But the 6 and 7%, borrowers who were in high debt, paying credit cards at 22%, paying car note at 9%, 8%, would do a cash out refi at a 6% because they can consolidate all their debt and just to be under one payment. And that debt is spread across 30 years instead of the 1 year, 2 years, whatever your credit card terms are. So people do refi in the 6-7% market because they're paying at a higher interest rate. Student loans at 13%, credit cards at 29%, car notes are above 9 now. So people do refi on a house, especially if they have equity.
Yep.
But people don't talk about it as much. But you can refi in this market if you have a higher debt payments or anywhere else.
Exactly. Another pro is higher debt to income ratio. So you can go up to 55%, which conventional is 50%.
They say 50, but
Like we said before, to get the green light on the computer, it's really like 45%.
Yep.
And then up to 50 depending on the other factors. But FHA, it's pretty maxed out at 55%.
And sometimes it's really that 1%. You're at the borderline at
Even
49.
55.5.
Yeah.
55.5 might not work, but you go to 55.4, it goes. So that's why you need a really good loan officer that can handle this stuff. Also, another pro of FHA is the FHA loan. The interest rate on average is lower than a conventional mortgage.
Yep. Yes, indeed. And if you have an FHA loan, and if you want to do an FHA streamline,
That was exactly the next point. Perfect.
The FHA streamline. So that refi is great. There's no more income verification. They waive the appraisal.
No hard credit pull.
No hard credit pull. And basically, they already know that you already paid that mortgage insurance, that you got a QM loan through a bank. So for that streamline refinance, they're not really checking everything again. And you get right now, 6 months ago, we closed loans at 7.5% for FHA clients. Right now, they're refining at as low as 5.9 or almost 6.1.
Yeah.
Which is on average a monthly saving of 240, 230.
Yeah, it's phenomenal. It's phenomenal. And then last pro that I have on this list, and there are more pros, but last one we'll go over today is you can get up to 6% in seller's assist.
Yes, that helps with closing costs.
Yep. Down payment, closing costs, pretty much that bottom line number, you can get greatly reduced up to 6%. It's a lot of money. The
closing, I don't know if you remember the Frankfurt deal. The closing I did in May. It was a quadplex, first time home buyer. He offered 270. He got 6% in seller's credit.
Wow.
Because he went FHA.
Wow.
If you went conventional, the conventional max is 4%.
3%.
Sorry, 3% on when you put less than 10% down.
Less than 10% down.
Yeah, if you go more than 10%, you can go to 4%. But yeah, you only get 3%.
5. I'm doing one right now. I think getting 5% right now.
Yep. So, 5% on a seller's assist on a conventional loan product if more than you put 10% down.
Yes.
If you put less than 10% down, on average, everyone does 3% down for conventional. They can get a 3% seller assist. With the same concept, you go to FHA with 3.5% down, you get 6% back from the sellers.
Yeah, it's incredible.
So that guy closed with a quadplex. His real out-of-pocket expense would have been closer to 30. He came to closing with $18,000.
Wow, that's amazing.
And he's cash flowing about $700 a month.
That's house hacking right there, guys.
That can only be done with an FHA.
Yes. Next, we're going to go over some of the cons with an FHA loan. There are some cons, not all pros. First con is lifelong mortgage insurance premium unless you're putting over 10% down. Putting over 10% down, then I believe it falls off after 11 years. So 10% down or more on FHA loan, it does fall off after 11 years.
But you got to put 10% down.
You have to put 10% down. If you put less than 10% down, you put the minimum 3.5% down, you'll have mortgage insurance for the full life of the loan.
Until you refi into a conventional loan.
Correct.
That's if you refi or when you refi.
Correct. Next con is there are lower loan limits compared to conventional. So I think the loan limit right now, as of late 2024, is about 485,000, something like that. It's close to 500K, but not quite.
You're correct.
Okay. And then the mortgage insurance is fixed at 0.55%. And that's typically higher than conventional. So conventional, if you have a great credit score, you're not getting, your premium is usually not 0.55%. It's usually like 0.2 maybe, sometimes even lower. And the way you can figure out your mortgage insurance premium, which is FHA's version of private mortgage insurance, is you take your loan amount times 0.55%, and then you divide that by 12. And that is your monthly mortgage insurance premium. Correct. Yep. And then last kind I have is stricter appraisal requirements.
Ooh, that's why sellers don't like FHA.
That's why exactly. So why don't you explain some of the appraisal requirements that might fly on a conventional loan but will not fly on an FHA loan?
The most issues I've seen on an FHA appraisal is paint chips.
Yeah.
If you're not buying new construction, you're going to have some kind of paint chips, some kind of skimmish on the wall, especially railings coming into the house. You also need railings in your basement. Any kind of hallway corridors, you need railings on an FHA appraisal. Conventional, they don't. That's why sellers don't like accepting an FHA offer, because they now have to do these repairs that's going to come up on appraisal. And if your appraisal fails or get a subject to, then that loan cannot process until these repairs are complete.
Right. It's called cost to cure. So let's just say, like you said, paint chipping, they'll even include the exterior. So if you have a window outside, let's just say the window's cracked, which any window being cracked, that's a no-go. So all windows have to be perfect. Paint has to be perfect. But there's chipping outside of the house with paint chips, they'll even make you replace that as well on FHA appraisal.
Yep. So that's why sellers don't like it. But anyway, I mean, but again, these repairs, cost of cures, the appraiser will put thousands of dollars because, replacing a window, whatever. They just don't want to see paint chip. You sand and paint, you can, again, push through the loan. And sometimes it's just hand-holding the realtors and the clients and getting them to closing. Because any appraisal issues I had on an FHA, between the sellers and the buyers, we were able to work through it, figure out what needs to be done, calling the appraiser, hey, what would satisfy these conditions? I don't think I ever seen an appraiser cost to cure, that's always in the thousands of dollars. It costs thousands of dollars. Yeah. Usually it's going to be done by a handyman or whatever needs to be done.
Correct. Yeah. Most are fixable.
Yep.
And then that's also up to the loan officer as well. Because if I have someone that I'm writing an offer for FHA loan, I always go on Zillow, Redfin, whatever website I can, Realtor.com, and I look at the pictures of the house. And I'll tell you right off the bat, just based off of our experience, you can look at a house and say whether or not it'll probably pass for an FHA appraisal or not.
Correct.
If you can see in the pictures, there's paint chipping, windows, railings, any sort of safety hazards, anything that makes it where it's not habitable at all or has a lot of issues, you're going to want to go conventional for those ones.
And FHA loan does not allow you to buy a home that just did a deed transfer in less than 180 days.
If it was bought with an LLC, right?
Or personal.
180
flip
days.
Rule,
Flip rule.
It's anti-flip rule.
FHA flip rule.
So 2 things that we do at Loans Incorporated is especially when we're offering an FHA, is when the seller's agent calls, I do ask, hey, was there a deed change? Was this recently bought or sold within the family? Because sometimes it's not being sold, but just deeds are transferring within the family. I told them, hey, this is an FHA offer, so be mindful that if it's a transfer that happened in less than 180 days, we need to wait that out. And like what you said, looking at pictures, I told them, hey, is there any loose cabinets? Is there any paint chips? Is there anything we need to be aware of? And again, a lot of agents out there are just worried on accepting an FHA, things they have to do thousands of dollars repair, but it's really not that.
No.
Most of these times we can get to it before even the appraiser comes. Hey, I saw the pictures. There's one cabinet missing. Can you just put a door on that? Hey, I saw some paint chips on the garage paint with photos. Can you fix that? It's usually just windowsills. Exterior ones are just windowsills and stuff, and then sand and paint. It's not that hard.
Yeah, 100%. So next, we just want to go over a couple of the FHA down payment assistance options through an FHA loan. The first one is the Empowered. So the Empowered Down Payment Assistance Program allows you to get an FHA loan, and the minimum 3.5% down payment is fully covered by fully forgiven grant. So at closing, you get a grant to cover your 3.5% down payment, and it's forgiven at closing, meaning you do not have to pay it back. Now, the caveat with this loan product is the rate is typically 0.75% higher than a regular FHA loan. However, after 6 months, you can refinance out of this loan to a lower interest rate. And also another thing to consider with the Empower program is the debt to income ratio limit is typically lower than regular FHA. So this product's really good for if you have the income, you
have minimal debt.
You have the income, you have the minimal debt, you have a good credit score, but you're looking to save as much cash as possible. This is the program for you.
The one I've done with EPM that allow that forgivable grant, we combined that with the 203K.
The one you did with Empowered?
Yep.
So the one Empowered you to what happened?
So we were, it was not a fix and flip, it's a rental. It was a 203K.
Yes,
so FHA has 203K and 203B. B is a normal FHA loan. No extra money is given by the bank for renovations. A 203K loan means you're buying it as an FHA, 3.5% down, and you're getting some money for repairs and renovations. Yeah. So our client got $56,000 in bank's money to fix the house. On top, they got $11,000 in forgivable grant.
Wow.
And they did get a higher interest rate, but they're ready for refi right now.
Yeah,
and
streamline, right?
Streamline refi. And they're going to be right back at right next to 5.5 because they had great credit. They only went the 203K route because they wanted the money for the renovation.
That's amazing. And then if you have renovations 35,000 or under, it's a limited to a 3K. And you can also do this through conventional as well. But under 35,000 or under, it's way less documentation. And if you go over 35%, then you're going to have a lot of contractor documentation, plans, budgets, all that type of stuff.
Imagine you walk through this house in the neighborhood you always wanted to buy in, the school district you want, but the only drawback was outdated kitchen or ugly kitchen. And you know, a kitchen upgrade might be in the thousands of dollars, maybe $10,000, $15,000, but that's the only issue with the house, an outdated kitchen. So now you can get a limited 203K, buy the home, renovate the kitchen, and be all under one loan mortgage payment.
That's incredible. Yeah,
It helps. Again, there's tons of great programs out there, great incentives out there, free money out
Yes.
there to help you buy a home.
yes, there is.
There is no excuse in 2024 not to be able to buy a home. I'm sorry, I just have to say that.
Next, just want to breeze over USDA loans because they're pretty straightforward. So a USDA loan is a type of mortgage, and it's backed by the USDA, the U.S. Department of Agriculture. So it's designed to also help low to moderate income homebuyers purchase homes in rural areas. So you can look this up. There are maps through the USDA where you can see if your county or your address is in a rural area. There are some suburban areas that do qualify. If you're looking at Pennsylvania specifically, every single county in Pennsylvania has an area for USDA loans besides Philadelphia County. So Philadelphia County, any other county besides Philadelphia, you can. And these loans aim to promote homeownership in densely populated areas, in less densely populated areas.
Basically, they want you to buy farmland, agricultural land, a house on a large piece of land, so
Right.
you can end with 0% down.
Yeah, so a big part of the, like you said, some of the pros, you can finance 100% of the purchase price, and there's no down payment needed. So these are really amazing products.
Yep.
The interest rates are also very competitive. They're very great interest rates, and there is flexible credit requirements. So you can get these. You can get a USDA loan with a lower credit score. There's also lower mortgage insurance costs. So these costs are typically less than private mortgage insurance for conventional loans. So your payment's going to be lower. You're going to have a lower interest rate. You're going to be able to finance all the costs into the loan. And then the only caveat really is, is the property eligible? Is it in a rural area? So these are some of the things you have to consider before getting a USDA loan. So some of the cons, obviously the big one that stands out to me is the geographical restrictions.
Yep.
If you're not in a rural area, then you can't take advantage of this.
For a city boy trying to take advantage of USDA, you're gonna be leaving the county.
Yeah. Now, if you work remote, you and your spouse work remote, or you live by yourself and you want to live in a more affordable area and you still want to buy, a USDA loan might be great for you. If you like the outdoors, you like being in more less densely populated area, look into USDA loans, see if there's any properties in those areas that interest you.
And if you want to grow your own food, grow your own crop, raise livestock, have a big backyard for your dogs to run around, for kids to play in, USDA loan is probably the product for you.
Now, there is, just like FHA, there's an upfront guarantee fee, but these can also obviously be rolled into the loan and financed. So that's for the mortgage insurance. But it is slightly lower in cost. It's not as expensive. Next, we want to go over VA loans.
For the veterans out there.
All you veterans out there, thank you for your service. We appreciate you here at Loans Incorporated. So what is a VA loan?
It's for veterans who did their time, who served the country. It's a great product for them. Again, another 0% down per loan product.
So yes. So a VA loan, it's guaranteed by the U.S. Department of Veteran Affairs, and they're available to all eligible veterans, active duty service members, and certain members of the National Guard and Reserves, as well as some surviving spouses.
Yep.
So there's always a question on the application: are you a veteran? So you'll get this if you do a mortgage application: are you a veteran? Did you serve? Did you not serve?
Or actively serving.
Yes. Or actively serving, or are you a surviving spouse? So let's go over some of the pros, Don, because VA loans are amazing options. If you're a veteran, you served, you want to take advantage of one of these loans. So let's go over some of the pros.
First thing, no down payment.
No down payment required. So that's amazing. That's the most amazing part about this, because veteran loans, I mean, you can go up pretty high too. So, for example, if you want to go a veteran high balance, those are the loan limits are pretty high. What are they at now? I mean,
I would have to check for the 2025 ones, but it's probably up there with the conforming loan limits. Again, pretty sizable loan products.
yeah, VA home balance. Let's see. I'm gonna go ahead and look into that. I believe right now the VA loan limits are up to $766,000. So it's pretty much at the conforming limit. So that is incredible. So not only
if you needed 3% of that, that would have been $21,000.
correct,
But now you have
zero
for being a veteran.
Yes.
On a $700,000 loan limit, loan size. Traditionally, you would have needed at least minimum 21,000. Now you need 0%.
So another pro compared to an FHA loan, compared to a conventional loan, there's no private mortgage insurance. So not only can you put 0% down and 100% finance the loan, there's no PMI. There's no private mortgage, no mortgage insurance premium. So that's also going to make your payment lower.
Oh, substantially lower.
Yes. Now, what about the interest rates? Let's talk about this. VA loans, talk about how competitive these interest rates are.
They're subsidized and they're set for people who serve the country for who did their time, you know? So the rate's obviously going to be better for those who did their service.
And there's another product for a refinance called a VA interest rate reduction loan. Now, if you bought a home within the last 2 years and you're over 6.5%, 7% over that, and you bought a home with a VA loan, I would highly recommend reaching out to us and looking at a VA interest rate reduction loan. These rates right now are extremely low.
It's so silly if you pass in these rates right now.
Yes, they're amazing. And also there's no hard pull required. There's no hard credit pull required, no income verification.
No appraisal waivers.
Appraisal waivers.
We're right now at the lowest credit score interest rate in the last two years right now.
Yeah.
2 years, 24-month period. This is the lowest the rates has been.
And this was recorded, we're at end of September 2024. So if you're watching this a little later on, just reach out to us and we'll tell you right now if it's a good time for an interest rate reduction loan. But if you bought your home in 2023, 2024, earlier on, mid on, it might be a good idea to take a look at a VA interest rate reduction loan.
I agree.
Also, credit requirements. So this is something when I first got into the business and when I was a junior loan officer and I was going over applications for veteran applicants, I never really knew what the minimum credit score that was required for
To be
veterans.
honest, I don't.
So here's what I found out, Don, because I see you.
Yeah, I don't want to be on the spot on this, but I feel like
So there is no minimum credit score.
get out.
There's no minimum credit score for a VA loan. And with a VA manual underwrite, that's really what you're going to look at. Manual underwriting guidelines for if you're a veteran and you don't know what you can qualify for with your credit, reach out to us because when we put you through the pre-approval process, we're going to go and get your whole entire file verified by an underwriter. And you're going to have a strong, confident approval in hand. So there's also the debt to income ratio requirement. There's also no maximum debt to income ratio.
Okay. Again, all these pros I'm hearing being a VA and buying a home.
Yeah.
0% down, less mortgage insurance, better interest rate, and wow.
Yes. Let's go over some of the cons though, because there are some cons with a VA loan. So while VA loans do not require any PMI or mortgage insurance premium, there is a VA funding fee. So the VA funding fee, and that can be financed into the loan. But that fee varies depending on the loan amount and down payment, if any. Next up, obviously, this one is important, but it has to be your primary residence.
Of course.
So it can't be a vacation home or an investment property. It has to be your primary residence. But probably the biggest con out of all the cons for VA loan are the appraisal requirements. So with giving how competitive is right now, if a realtor or seller were to get a conventional offer and a VA offer, both were the same exact terms, they're probably going to take the conventional offer.
Yep.
And the biggest reason for this is the appraisal requirements for a VA loan are stricter. They're stricter than conventional. If there's anything that needs like paint, chipping,
It's up there with
windows,
an FHA appraisal.
it's very similar to FHA appraisal requirements. I think even a little stricter. Last con is entitlement limits. So you do have entitlement as a veteran. And if you're looking to buy, higher price home, if you don't have enough in entitlement, you would have to make up the difference in down payment to cover that.
And again, these are things that your loan offers at Loans Incorporated can help you with. These are not something that you can figure out on your own or decide. We will also work with your, not a case manager. The one VA loan I've done, it was someone at the veterans office that you work side by side with as your loan officer and with the borrower's veterans affairs representative. You work together on getting the disability, the DD, it was a DD 25.
Yeah, so with the VA, you have your DD 214.
214
That's
form.
where you give the underwriter to show your eligibility,
for
entitlement, everything. So you'll have a rep over at the VA, the Veterans Affairs, who will help throughout the process.
And we will work with your rep. We will help side by side with the realtor and getting you that loan at 0% down. This is why, again, I always go back. It's very important to talk to a experienced, licensed loan officer because these can be only done with them.
Yep. So let's go over some of the common myths real quick on the VA loan. So VA loans are only for first-time home buyers. That is not true.
Nope.
No, you don't have to be a first-time home buyer. Now, if you do decide to buy your second home, third home with a VA loan, just check your eligibility and your entitlement and whether or not you have to sell your home to get some entitlement. So VA loans are only for single-family homes.
No,
you can go up to 4 units on a VA loan. You can buy
could you imagine house
condo. Yeah, you can.
on a VA loan? How crazy is that?
That would be crazy. Yeah, just
This is for all the
buying
veterans out there. Please, I would love to do this loan. I've never done a 0% on a multifamily. Let's make this happen at Loans Incorporated.
Yeah, if you're a veteran, you're looking to buy a 4-unit property with 0% down, we'll get it done for you.
Call us.
Yeah. So veterans or VA loans have high interest rates. So that's not true at all. VA loan and their interest rates, like we were talking about before, they're great. The VA issues the loan. That is not true. So the VA does not issue the loan. The lender issues the loan. The VA just guarantees a portion of this loan.
Correct.
So that's going to reduce the risk for the lender. So next segment, and this is something that is getting more popular. The percentages are up. These are non-QM loans. These are called non-qualified mortgage loans. This is a category of home loans that do not meet the traditional criteria set by Fannie Mae and Freddie Mac, which are the government-sponsored entities that are the big players in the mortgage industry. They're also not of the traditional criteria set by the FHA, VA, or the USDA. These are loans designed to accommodate borrowers with unique financial situations. So we're going to go over 2 products that are my favorite non-QM loans. We're going to go over the bank statement loan and the profit and loss statement loan. Okay? So let's go over who are some of the people who would benefit from a non-QM loan.
Oh, business owners.
Yeah, the big thing that stands out are self-employed individuals.
Yep.
Small business owners, but people with irregular income streams.
Yep.
So
Any, what's it called? Not landscaper. Was it freelancers?
yeah, freelance. Let's just say you're a streamer. You're a Twitch streamer. You're a professional gamer. This is a chance for you to buy your home. YouTuber, social media influencer.
Yeah. Different incomes other than your W-2 incomes.
Right. Let's just say you do commission-only sales and you just started that, and you only have 12 months of bank statement to show. If you're making $100,000 a year doing that, you can buy a home without filing the taxes to show that.
That's another myth you busted because
Yes.
people always think that you need W-2 income, you need work history, this, that, and third, but there's non-QM loan products out there that you could qualify for.
Correct. So let's go over the 12 to 24 month bank statement program. So 12 to 24 months are the set terms and periods of the bank statements. It's all the 12 to 24 months means. So you can either show 2 years of bank statements, for a lower rate. We can show 1 year for a slightly higher rate. So how it works is instead of relying on those W-2s or tax returns
Or pay stubs.
or pay stubs, the lender is going to assess your income based on 12 to 24 month period of business bank statements, or with some bank statement programs, your personal bank statements. And they typically average these deposits over this period, and then they'll usually be an expense factor. So an expense factor is like if you do some sort of commission sales, typically you have a lower expense factor, because if you're selling, let's just say cars, and you have an inventory and there's a cost of goods sold, then there's going to be a higher expense ratio. So let's just say, conservatively, you take, a lot of these will take up to 75% of your gross deposits. So if you made $200,000 in deposits, they'll qualify you based off of 75% of that $200,000.
That's $150,000 income.
Yeah, which is amazing. So like you said, some of the people these are ideal for are gonna be your self-employed, business owners, people with fluctuating income, or people who might not show a high taxable income on their tax returns. Then we want to go over a little bit.
That's key right there.
Yes.
Business owners don't show high taxable income.
Yes.
But they have deposits coming in. They have income coming
Yes.
in. They do have expense, but we're qualifying this loan based on their income that's coming in, not what they reported at the end of the year.
Correct.
This is great for restaurant owners. This is great for like musician, actors. Anyone,
Yes.
again, has that variable income that has these deposits coming in, but at the end of the year, they have expenses. So great loan products for non-traditional income.
And you can actually use a bank statement program and only put 10% down.
Amazing.
Yeah. So you don't need 20% down. You don't need 30% down. Only 10% down for a bank statement program. So really quick, want to go over profit and loss statement loan program. Have you ever done a profit and loss statement?
No.
So I've done a few of these. I think they're amazing programs. So if you get a profit and loss statement prepared by your CPA or a tax preparer, they don't have to be a actual certified CPA, with 2 supporting bank statements, you can get qualified based off your profit and loss statement. So this is pretty much
On any business, it could be a profit and loss.
it could be any type of self-employed business, sales, car dealership, restaurant, anything like that. So they do a profit and loss statement and just need 2 bank statements to verify the profit and loss statement. This is really good for self-employed people who have significant deductions on their tax returns or report lower income on their taxes. So great for freelancers, small business owners, contractors who want to use their business's P&L to reflect their actual earnings.
This is why I love working at Loans Incorporated. There's so much out there that I'm not familiar with, but I feel like I do have a clientele, a demographic of clients that could benefit from this, and I'm glad you're talking about it.
Yeah, absolutely. Non-QM loans are great. Like I said, they're up. Non-QM loans have gone up in popularity because of the environment we're in the economy. There's more self-employed people taking risks, and these social media. There's so many more outlets for education on these loan products. Social media, email marketing. There's so many more loan products out there compared to what there was maybe even 5-10 years ago. So some of the pros, obviously, what would you say? Just the flexibility?
Oh yeah.
Yeah.
Sounds like easier underwriting.
Yeah. Usually less documentation, and then obviously not having to provide tax returns if you're self-employed.
Because I've seen people who make a lot of money, but their taxable income, due to the depreciation of the property or assets they own or expense of owning a business, will substantially decrease their taxable income or the net income. And the W-2, we look at gross pay. So conventional FHA, VA, USDA, we're looking at gross pay on a W-2, but bank statement loans or profit and loss, we can also look at what's coming in. But if you are buying if you're buying a home, we use a conventional method and you're self-employed, we look at net income.
Yes.
That's a big difference if you're a business owner versus a W-2, is the fact that and this is not just the Loans Incorporated thing. This is a Fannie Freddie rule across America, all 50 states, across all banks. Is if you're a business owner, you're trying to buy a home conventional method, they have to look at your net taxable income or net income versus your gross income on a W-2. That's why there's an uptick or a rise in non-QM loans right now.
Yeah.
With the profit and loss statements and the bank statements because like you said, there's a lot more people taking risk and doing different jobs. It's not the W2 anymore. It's not
Gig economy.
Yes. Yep. Yeah.
DoorDash, Uber, all types of things.
The factory work lifestyles went out the window now. It's more of those.
Yep. So cons, higher interest rates. So these rates are typically half a point to a point higher and larger down payment requirements. You're not going to get one of these loans with a 3% down payment. You're going to be looking 10% to start.
Alex, can you buy a house with a bank statement loan and put it under your LLC and not have it hit your credit? Or does it have to be a DSCR?
You can if it's an investment. So if you're doing an investment loan, it can't be your primary. You have to close. If you're going to close an LLC, it has to be an investment purchase. It has to be business purpose to go in your LLC.
That's good to know. Okay.
So that's going to go to our next point. We're going to go to DSCR. So a DSCR loan stands for debt service coverage ratio. So this product looks at your subject property's potential cash flow and income rather than your personal income. So these are built for investors who are looking to qualify based off of the property, not themselves. So these are ideal for people who are looking to buy a property and rent it out. That's what they're built for. That's what they're made for. If you're a real estate investor and you're looking to invest into properties, you can go up to, most of these DSCR loans, you can go up to 12 units. So there's some 12 unit property programs. And credit requirements are pretty, depending on your experience, you can get one of these DSCR loans for 600 credit score, sometimes lower with some special investors. So you don't need an 800 credit score to get a DSCR loan. Especially if you're an experienced investor and you have some collateral, you can get a DSCR loan for if you have a lower credit score.
Again, this DSCR loan is great for investors, business owners, people with, variable income because they're not qualifying the loan based on your income. They're using it as a subject property. So when you do the appraisal, there's a rent schedule with, I believe, 1007. So they do a rent schedule on the appraisal. Is it 1007?
A 1004 or with 1004 with a 1007.
1007. So 1007 will show the rent schedule for that property.
Yes.
So appraisal will look at comps in that neighborhood and they will see, all right, for this multifamily or single family purchase, the rent will be, let's say, that's Huntington Valley rent for a 3-bedroom house is $3,000 and the purchase price is $450. So as long as the 1-to-1 ratio or higher in the sense that you're making more income than your expense, the bank will give you a loan based on that property's income.
Right. So the debt service coverage ratio, let's just say the rental income is $3,000, or your mortgage payment will be $3,000. That's a 1% ratio. Now you can go below that.
Yep.
There are no ratio DSCR loans, but you're going to pay for it with the interest rate. The interest rate is going to be higher.
Yeah, it's going to be higher, and I think 30% down.
And you do not need to be most of these DSCR loans, you can't be a first-time home buyer, but you
or
can,
owner occupied.
Yes, they cannot be owner occupied, but you can also be a first-time investor.
Yeah.
So these are great products.
The bank is willing to give you up to 70% loan for a new investor.
Yeah.
And they're not using your income.
Some allow you to go up to 85%. That's a 15% down payment where you don't have to show your income. You're
not tying your credit to it.
No, you can close with your LLC. So it's a great program. If you're looking to invest in real estate and you don't want to get turned down because of your income, look at a DSCR loan. So we're going to talk about some local Philly and Pennsylvania grant programs. So we're going to talk about...
I love these.
Yes. This is Dhan's specialty. Dhan Thomas is the grant professional here. So tell us a little about your background and how you've helped families save money with purchasing a home.
So I've helped 17 families acquire about $150,000 in grant. So if you do the math, on average, I was getting about $17,000 per family in one way or another, either down payment assistance, grants, forgivable loans. Basically, they were to reduce their cash to close in buying their first home by getting grants, either the Philly First, the PHFA state grant, or Rocket One Plus.
Purchase Plus.
Purchase Plus, sorry.
Yeah, so Purchase Plus. So let's go over some of these programs real quick and some of the points, and we'll direct you through as we go through. So let's talk about, and I've also done about $100,000 in grant funds within the last 24 months.
That's amazing.
Yeah. Thanks, man.
You save your clients $100,000. That's amazing.
Yeah. Yeah. Clients over the last 24 months have saved about $100,000. And that's through Philly First Home, PHFA, and the Purchase Plus. So let's talk about Philly First Home. So I'm just going to go the steps of the process, and then you can give your part as well. So Philly First Home, first step is to take a pre-housing counseling certificate called Framework. Take this online.
Which is free.
It is free. Next is to schedule a one-on-one counseling session with a HUD-approved counselor.
Which is free.
And we'll also help get you set up for that appointment. Next is to get a grant approval from them. Next is to go under contract. So you cannot be under contract before you complete the first 3 steps. And then you can receive up to $10,000 in grant funds, or 6% up to $10,000. Now there's a potential holdback for you with this program. There are income limits.
Yeah, that's the biggest drawback is the income limit, because if you're filing single or buying this home by yourself, it's $81,000.
$80,300.
$80,300. And if you're a married or 2-person household, it's about $91,000. And then if you have a child, or you can be a single mother with 2 kids, however the household income is based on 1, 2, 3, or 4, it's $80,000, $90,000, $100,000. So obviously the income limits is much smaller here, but if you're buying a house in the $200,000 range, this is perfect. You have enough income to be at 50% debt to income ratio to get the loan. And I love the Philly First, because you could go as low as 500 credit score or 580 if needed. Or you could be at a 660 credit score, get the home possible rate as well. Could you imagine getting a subsidized interest rate and getting $10,000 in closing grant?
And you can also go for the Purchase Plus program.
Combine 2 grants? That's amazing.
Yeah, if you currently live in an underserved area, and we have a search tool that can help you determine whether you live in an underserved area or not, and most metro areas in the country have underserved areas, you can stack a local agency program like Philly First Home and get a grant from the city plus a grant from the lender. So Purchase Plus a grant from the lender. Most are around $5,000 to $7,000. Then I want you to touch on PHFA. Give the audience a rundown on a PHFA loan.
So PHFA is great because it's a higher income limit. So you're for filing single on your taxes. I think for Philadelphia County is $121,000. If you're making $121,000, you can get up to 5% of the purchase price.
Now keep in mind, for those looking at the Philly First Home and PHFA, you cannot do both.
Yep.
So they both
apparently there was a time that you can, but not in 2020, not since 2022.
No, so Philly First Home is a community second, so it is a lien attached to your home, but you do not make any payments on it. And PHFA is also a lien attached to your home,
You don't make any
and
payments on it. It's forgiven in 10 years.
it's forgiven in 10 years. But both of them want to be on the second lien position. None of them will take the third, so you can't do both.
But that's why you can do the Purchase Plus and the Philly First.
Yes, but PHFA you cannot do
It's a
Purchase
standalone
Plus
grant, but 5% of the purchase price. So let's say right now in 2024, the
for
Philadelphia
PHFA.
for PHFA, it's a standalone grant. The purchase limit is $650 on a home. That means you can go up to a $650,000 home.
Wow.
If you're filing single on your taxes, you can go up to $120,000 income. If you're married or have a child, you can go up to $130,000. So again, higher income limit, higher purchase price, 5% down. I think the most I've done on a house was $22,000. The cash to close without that grant was $33,000. We were able to get them $22,000 in grant. They came to closing with just a little over $10,000, and they got their first dream home.
Wow.
With just $12,000.
That's amazing. If you want to get started with that, we're going to have a link in the bio of this video. And it's going to take you to Don's application. He'll get you set up with a grant right away.
And the other differences between Philly First and PHFA is with PHFA, there's nothing you need to do prior to being under contract. With Philly First, before you execute a contract or go under contract, you should have completed your one-on-one counseling, get the home buying certificate all completed prior to going under contract. With PHFA, you don't have to do anything until you're under contract.
Yep. Next, we're going to talk about reverse mortgage. So reverse mortgage is a unique financial product, and it's designed for homeowners 62 or older, and it allows you to convert a portion of your home equity into cash. So this type of loan is beneficial for retirees who are looking to supplement their income. This is to cover living expenses, fund healthcare costs, without having to sell your home and move. So you borrow against the equity of your home, and you're receiving funds either as a lump sum or monthly payments. This loan does not need to be repaid until you sell your home, move out, or pass away. Interest is added each month to the loan balance, and the total amount owed increases over time. So the pros is you have no monthly payments, you have access to cash, you get to stay in your home, and it's a non-recourse loan, which means you will never owe more than the home's worth at any time of repayment, so it protects you from market fluctuations. The cons are you have decreased equity in your home. There are costs and fees. You do have to have property maintenance. So this is required. You have to have, you have to pay your property taxes. You have to keep your mortgage insurance current. And here's some common myths. You lose ownership of your home. That's not true. You retain ownership of your home and you can continue to live on it as long as you meet your loan obligations. They're only for financially struggling seniors. That is not true. Reverse mortgages are not only for financially struggling seniors. If you're looking, if you have adequate income, you can use the reverse mortgage to enhance your financial flexibility, do more in your retirement. And another myth is they're a last resort. They can be part of a broader retirement strategy, and it's not just a solution for those in financial distress. So reverse mortgage can be a great option.
Yes, if you're at that age above 60, reverse mortgage.
62.
62, that's a great option.
Yeah, if you're above 62, Don, would you say that if you're needing extra income as a retiree, how would you say a reverse mortgage can help you?
You're getting a lump sum at once, and you're just paying, you don't have to pay it back. Basically.
Right, and you can also get disbursements over time, over monthly periods. So if you want to set up, hey, I want to do a reverse mortgage for 10 years and I want to take out $600,000 equity of my $1 million home, you can set it up in that way. So they're flexible.
Again, it's free money. Not free money, but essentially it's free money.
Yeah, because you're taking equity out of your home that you've already paid into.
It.
So next is a home equity line of credit. Home equity line of credit is a revolving credit line that allows borrowers to borrow against the equity in their home. It operates similarly to a credit card where you can draw funds as needed up to a credit limit, repay, and borrow again. So homeowners can access a line of credit based on the equity they've built up in their home. They can withdraw money as needed during a draw period, which is typically 5 to 10 years, and only pay interest on the amount borrowed. After the draw period, borrowers can enter the repayment phase where they pay back both principal and interest. So you can also do a HE loan where you get a home equity loan, which is fixed interest rate. And you get this for 30-year terms, 15-year terms, 10-year terms, 20-year terms. So the benefit with this is the rate stays the same, while HELOCs, the rate can fluctuate with the market.
And right now, people are doing a lot more HE loans because it's a second loan on your house without touching your first loan.
Yes.
Let's say you bought your house in 2019 or 2020 during the COVID time. You got your mortgage as low as 3%. Or let's say you bought a house even before then, you refied. Your first mortgage interest rate is 3%. You don't want to touch that. But you have $200,000, $300,000 worth of equity in your home. So what people are doing now is they're just getting that HE loan or the close end second and paying 7% on that. So basically they're carrying two mortgages on their house, one at 3%, the other one is at 7%, but it's fixed.
Right. So if you're paying 30% on credit cards, you have a high interest rate car payment, you can just take out a HELOC, pay 7% on a HELOC instead of paying 20%, 30% on $100,000 in debt. Go get a HELOC, pay off that debt, and then you'll pay a lot less interest over time.
It's so sad that people don't have this information or don't know about this, and they're just spending so much money on interest.
Yeah.
So much money in fees and penalty and taking a longer time to pay back a 30%, 20% credit card. I have friends who have taken $10,000 on their credit card to pay for a trip to go somewhere like Europe or not a cruise. And they're just paying that 20%, 30%.
Correct. So if you're going to go ahead and get a HELOC, you can get an initial draw. You can take $100,000 on a HELOC, right? and you need 10,000 for a trip and then pay it back. You don't have to carry a balance on your HELOC, but it's access to those funds, and you're not going to pay an arm and a leg in interest. It's going to be much lower than a credit card.
Yep.
So if you're going to take a trip or a big expensive vacation or a wedding for $50,000, it might be worth it to take a look at a HELOC because that's going to be at a much better rate than other debt. So Don, this was very informational for our audience, and
I agree.
I look forward to assisting you all in your home buying needs. Any mortgage questions?
Debt consolidation, second home, vacation home, or even short-term rentals, non-QM stuff. We're not just one dimension loan officers. This is not a one dimension company. We are here designed to help you guys get all financing questions answered and get the right loan product that fits your need. Because trust me, to get a grant, the underwriting is harder, and then there's a lot more paperwork.
Yes.
There's a lot more hurdles to jump. Most loan officers don't want to take that on. They rather deal with most loan officers rather deal with a client that's conventional, 20% down with a W-2 income. Trust me, I have pulled out enough hair working with business owners, self-employed people on getting a DSCR loan. I've spent a lot of nights doing government paperwork, filling out the FHA documents, trying to get my clients the grant. And most people don't want to go through this because it is a lot of work.
Yes.
But at Loans Incorporated, our loans officers are dedicated in getting the clients, getting our borrowers the best loan product that fits their need.
We put service first. We invest in the top technology for the mortgage industry. Our process is streamlined, and we're here to put you at the center focus and give the absolute lowest rate possible.
Quote me on this. It should not take more than 2 hours to get you a pre-qual letter.
No,
It
never.
should not. If you're doing banking with someone and they're taking a day, 2 days, 3 days to get your pre-qual letter, something's wrong.
Yes.
It should not take more. And under automated underwriting system, if you go under contract, you should know within the first 3 days if this loan is going to work out or not. There should be no surprises at the end. Your realtor should not get a call a day before closing say, hey, we're not closing.
Yes. Awesome. Thank you guys. Thanks for tuning in, and stay tuned to more content soon.
Hit follow on Instagram, Progress with Pagano, or Mortgage with Pagano.
Yeah. So you can follow us on social, Mortgage with Pagano, and then follow our YouTube page, Loans Incorporated, and our Instagram, Loans Inc. And then follow Don
At Lending John.
Lending John. That's the Lending John right here. Awesome. All right.
Thank you for listening and tuning in. Appreciate
Thank
it.
you.
See you next time.
See you next time.